You're going to keep control of it all. Yeah.
I'll do that. That's no problem. I'm just going to start. Oh, that's good. We should be recording now, so that's fine. Great. Hi there, guys. I can see that we've got people joining already, which is really wonderful. We're just going to give it half a minute or so for a few more attendees to arrive, and then we will get started. Just while we're waiting, I have got a poll in the settings at the bottom, just asking you about where you are right now. So if you're just waiting for us to get started and you want to click on those polls at the bottom of your screen, you should be able to just fill that in and we'll keep a little eye on how we're doing. Vicky, can you tell me, can you see my screen okay? Is it all showing properly?
Yeah, it's fine.
Super. Okay, then I think we'll probably get ourselves started. Before we begin this webinar from Sole Traders Limited Company, just wanted to make sure that you're aware that we'll be recording today's webinar. So if there's anything that you didn't quite catch during the meeting, we will have a recording that you can go back over again, and we'll also be sharing this to people who aren't able to make it today. So from there, let me just get ourselves going and let's get started. So over to you, Vicky.
Thanks, Tori. Okay, so I'm Vicky Fielden. I'm the Operations Director here at Panthera and work closely alongside Tori. I'll be managing the webinar questions and overseeing the running of the webinar. And just to go over the Zoom features, just in case anybody's still unfamiliar, you can check your audio settings by selecting and testing your speakers under that audio settings button there. You can submit your questions via the Q&A button, and if you need to leave the meeting for any reason, just click leave meeting. And today's panelist is Tori Wagg, CEO of Panthera Accounting. Thank you very much, Tori.
Thanks so much, Vicky. It's really helpful for me to have Vicky here alongside me, and she's going to be sharing some thoughts with you a little bit later on during this webinar. So we'll hear a bit more from Vicky in a little bit of time. But I'd just like to say thank you to those of you who've taken time out of your busy day to join us on this webinar today. I know that for many of you, you've got really busy times. We're just coming up to the end of the tax year. So I really appreciate you taking the time out of your day to join us today. The plan for today's webinar is to give you a really practical and useful guide to making the move from a sole trader type of business into the wonderful world of limited companies. I always like to start one of our sessions with a thought for the day. You should be able to see that up on your screen. And today I've chosen this particular one from Henry Ford. Nothing is particularly hard if you divide it into small jobs. I've chosen this one because the move into running a limited company can seem incredibly daunting, sometimes just insurmountable for many people. Knowing where to start, what you're signing up for, and what needs to be done when to stay with, so that you can stay within the law, can be really terrifying, and it often makes business owners stall or just stop together on making that decision because it seems more than they can manage. At the other end of the spectrum, we sometimes see people jumping in blindly and not realizing until a few months or even years into running their company that they've started it on a rocky foundation and it needs to be taken apart and rebuilt in a way that's more sustainable. So the aim of today's webinar is to empower you, so you've got the knowledge and the signposts that you need to be a good director of a company, or at least to know where to begin. We've got a lot to get through today. We're going to run for about an hour, and then we'll have some questions at the end. We might just be a little bit longer than that, but we'll definitely be wrapped up by 1:30. So I think we ought to get stuck in. So here's our agenda for today. Before I get started on that, I'm just going to throw in our usual disclaimer. The information in this webinar is educational and it's general in nature. That's no substitute for getting tailored advice, which is specific to your particular circumstances, especially around this subject where there are lots and lots of ifs and buts, depending on how many people are involved in your business, what it is that you do, the sorts of industries you work in. So it's really important that you get some tailored advice if you decide to go down this route. So today we're going to look at why you might choose to be a limited company, what the key differences are between a sole trader and a limited company. You'll see this abbreviation quite a lot, the LTD-COs that we use, limited company shorthand. I hate using accountants jargon. I try really hard not to do it, but we're going to use that terminology so much today that you might see that shortening throughout the day. We're going to talk about what the legal obligations of directors are. It's worth you noting that if you become a director of a company, you do have legal obligations. There are things you have to do. And very often people start off as a director without being aware of what those are. What you need to be measuring in order to make this decision correctly, what the first year of a limited company might look like for you, what costs you can claim. That's a question we get asked so many times, so we thought it'd be really useful to pop that in here. What are you able to put into your business? How do I take money out of my business? That's the other one that often trips people up. So we're going to run through that, give you some of our tips and tricks, and then we're going to talk about next steps and then open it up for questions. So why would you choose a limited company in the first place? So first and foremost, the answer to this question is actually in the name. The company is limited, and that's because it's a limited liability company. And what this means is that your liability as an owner of a company is protected as long as you behave in accordance with the Companies Act as a director and that you don't do anything that's negligent. And we'll talk a little bit about that later. So that's why it's so important before becoming a director to understand what your obligations are and the basics of how a limited company is constituted, you know, what's going on in that entity. You need to understand what good governance looks like in order to run a company well. And if you're thinking about taking on staff, maybe going into premises, so you might get a lease, or entering into any borrowing or agreements that could be onerous, and by that I mean if something goes wrong that there could be some big consequences for you, then limiting your liability is a really important risk mitigating decision. What could go wrong? Well, it might be something, so this is an example from real life. We've had clients that have taken on retail units or, you know, taken on a lease on an office, and they've signed those long leases, so they might be signed in for something like 5 or 10 years. And then COVID hit. And if they were in retail, for example, they weren't able to trade, and so paying their rent became a real problem. We had a client where if they had stayed as a sole trader, which is how they'd originally set themselves up, and before they came to us, they'd signed a lease as a sole trader. They came to us, they took some advice, and we managed to get that changed into a limited company. Now that they need to get out of that lease, if they'd stayed as a sole trader, they could have been facing personal bankruptcy in this position. In effect, what's happened, because they've got a limited company, they've been able to step away in a really structured way from that company. They're able to go through a winding up process and no effect on their own personal finances at all, just that the company will get put to bed and they can go on and do something else in their lives. And if they'd remained as a sole trader in that position, it could have really meant an enormous upheaval for their family. So that's that sort of limiting of the liability that we're really interested in here. Limited companies also allow more flexibility around tax, in that a company can declare dividends to their owners. Their owners are the shareholders of the company, and they can do that at the time that suits them best. So if you don't need to take all of the profit available from your company, you don't have to, and therefore you're able to plan when to take money out in the most tax advantageous ways. The next point is that corporation tax is currently running at 19% at the moment. In the last budget, in that spring statement we saw from the Chancellor last month, there was an announcement of a plan to reduce personal income tax from 20% down to 19%, but that hasn't happened yet. So as it stands, it's still tax advantageous to make profits of somewhere between 16,000 and something up to about 300,000 in a limited company if you compare that to a sole trader. We're not going to go into the nitty gritty of the maths today because it is complex, but it's just worth you knowing that if you're making more than about 15,500 to 16,000 pounds of profit, you're going to pay less tax with the right structure in a company as opposed to being a sole trader. It's marginally better to be a sole trader if it's under 15,500, but we're talking savings in tens, maybe up to the low hundreds of pounds. And that's without bringing into the other benefits of your company having that limited liability. So very often we suggest that the limited company route is the right one for most people. Limited companies allow you to have multiple owners. Now, yes, you can also have multiple owners in a partnership. And for the benefit of this webinar, we're going to talk about sole traders. That's one person running a self-employed type of business, as opposed to a limited company. Partnerships allow more than one person to be involved, but they still count as self-employment. And so you can bring in other people in that way, but they still don't have the benefits of the limitation unless they're a limited liability partnership. You sometimes see that LLP at the end of things like solicitors firms, some accountancies as well take this route, and they have a slightly different structure. But for today, we're going to take that complexity out and just talk about either being a sole trader or being a limited company, because that's the choice that the majority of people we talk to are having to make. So limited companies let you have multiple owners, lots of shareholders, and this can be really useful if, for example, you're a family-run business, or you're going into business with your partner in life, and you want to be able to share profits across a number of you. It can be very useful from a tax place, because you can also use those people's tax allowances to minimize tax across the board of the people that you want to get your profits out to. Coming down to that public perception part, perception of your business from your suppliers to your customers, perhaps to potential employees, it's really important how you're viewed from the outside world. A limited company can be seen as being more professional. It can look perhaps like a more solid and trustworthy business. And that's because of the way that a limited company, has to report and put information out into the public domain. And that means that stakeholders can go and find out a bit more about them. If you're thinking about perhaps, I don't know, taking on a builder to do a big piece of work at your home, if they've got a limited company, you can go and check out that they filed their last set of accounts, make sure that they're not insolvent. You can work out who the directors are, and you can get a sense of who that business is. If they're a sole trader, you've got none of that. And so it gives you that extra sense of solidity to their business by being able to check out a lot more information about them. And for potential suppliers, they might be running credit checks. They might be wanting to give you some terms that you can buy on. And very often a limited company is more appealing to them than a sole trader. So coming down to the thing about borrowing, a limited company can borrow in its own right. And that can be really useful, as it doesn't directly impact you and your personal borrowing ability or on your own credit score, for example. So the types of borrowing a company can do and the offerings available to it can be greater than perhaps you'd be able to have as just a person on your own. And you can invite in investors. You can perhaps give staff a shareholding, and even pass the company on to your employees at a later date if you're interested in going down that route. Finally, a limited company is an asset, and it belongs to its shareholders, and as such it can also be sold on. This is an easier transaction than selling a sole trader business, which is intrinsically wrapped up with the person who runs it. So a limited company sits as its own entity in its own sort of box, separate from its owners. And therefore, when you go to sell it, you can just sell the shares in that business and they can move on to somebody else. With a sole trader business, that's a little bit harder to unpick, and that often means that it's more readily saleable and therefore has more value in it. So if you're thinking about your exit planning, a limited company can very often be the way that you want to go. So what are the differences that we need to be aware of between a sole trader and sometimes also a partnership that we've just talked about, and a limited company? So you can see up on this slide, I've got a number of this versus that items. So let's just start at the beginning. We've got firstly, different year ends and deadlines to be aware of. So sole traders all have to put in a personal tax return, and the tax return covers the period to the 5th of April each year. Very often sole traders make up their accounts to the 31st of March rather than the 5th of April for ease. And it is also possible as a sole trader to have a different year end for your business. So some businesses will have a year end that's related to when they first started the business. So let's say you started on the 1st of August, you might have a 31st of July year end, and then that goes on to a tax return that runs to the 5th of April. That can be quite complicated for people to get their heads around. When you've got a limited company, you can actually choose any date you wish for your year end, although it is usual to choose a final day of the month because most people want to do a sort of wrap up at the end of the month. But you can find that it's really helpful to be able to have that flexibility about when your year end is, to fit in around some cycles that you might have in your industry. So it can be really helpful to set your year end into a point of time when perhaps you're not so busy with your day-to-day business. So let's say you ran a Christmas shop, you might not want a 31st of December year end because you're going to be so busy with doing other bits and pieces that you don't want to be stopping to do a stock check on the 31st of December. You might go for something like midway through the summer so that you've got plenty of time to do all of the sort of tidying up. And we have that flexibility when we've got a limited company. You might also want to think about what happens as you grow in a limited company and when you want to have that year end, because there are going to be other people involved in your processes. So quite often we say to people, unless you really struggle with moving from a sole trader to a limited company and you want to stick with the 31st of March, 31st of March might not be the ideal time because many accountants are going to be really busy with all of their sole traders with that year end, and you might want to get more from your accountant. So having a slightly less popular year end can be really a sensible way of making that plan. Secondly, limited company is a separate legal entity to its owners. And I say this, I'll say it again actually, because this is one of the fundamental mindset shifts that you need to make when you become a limited company, when you go into the limited company world. It's a separate entity from you. And the more that you can think of the limited company as sitting in its own box, away from you and your personal finances, the easier everything gets. Unlike a sole trader business, when you are the business, this company exists as its own person in law. And I say person in inverted commas, because it has its own rights and it has its own obligations as well. And it's really important to get our head around that fact. Thirdly, the sole trader profits belong to you as a person as soon as they arise, whereas the limited company profits belong to the company until they are distributed. And that's usually done by way of a dividend and very often also with a salary. And that thing about where the profits are and who they belong to, again, is a big mindset shift. But it's really important to understand that the limited company has profits that belong to it and it pays tax on those profits itself. So that comes down to my fourth point. When you're a sole trader, you're responsible for the whole tax burden of that company. And that might be PAYE, it may be VAT, it may be that you've got to pay national insurance contributions and you've got to pay personal tax on all of that business. When you've got a limited company, the limited company itself must pay its corporation tax, that's the tax on its own profits. And then any of your personal tax burden belongs to you as a person. So if you've got to pay tax as a shareholder because you've received dividends, you personally need to pay that tax. Your limited company doesn't pay your tax for you. Okay, and so that's a really fundamental thing to get right. Paying national insurance on profits. So a sole trader has to pay tax on business profits, but they also pay class 4 national insurance contributions on profits. And from this Wednesday, from the 6th of April 2022, the rate of national insurance, class 4 national insurance, goes up to 10.25% on profits. And I'm going to throw some numbers out there, but on profits over £9,568, up to the upper limit, which is now £50,270. They're really tricky little thresholds you've got there. But what you need to be aware of is that you very often think about tax as being whatever the income tax rate is at the moment, 20%. for the lower earnings rate at the moment. But actually, as a sole trader, you've also got this class 4 national insurance contribution, which works just like a tax, and it's going to be 10.25% from now on. So don't discount the amount of your profit that's going to get handed over to HMRC because of that class 4 national insurance contribution. And the reason that's changed is because of the health and social care levy that's coming in, this extra 1.25%. It doesn't only hit sole traders. So it's important to recognise that limited company shareholders are also going to get hit with that increase of 1.25% because it's going to be added on to dividend tax. And you're going to just need to keep that in mind. It's a real pain that we've got these awkward percentages, 10.25%. It's not something you can just work out. I usually say on the back of a fag packet. I mean, these days, you know, just in a notebook, you've really got to get a calculator out now that we've got these much more complex tax bands and tax amounts, but it's definitely something that your accountant can help you work through to make sure you understand what kind of amounts you've got to pay. Alongside this, sole traders have to pay tax usually twice per year. And I say usually because if you have a very small sole trader business, you might not have to make payments on account. It depends on how much money you have to pay in tax each year. But usually you're going to be paying at the end of January and at the end of July. And a sole trader makes payments on account, which means they pay their tax in advance of putting their tax return in. And that can create some cash flow problems for some people, especially the first time you have to make payments on account, because you have to pay all of your tax due plus half again for the year afterwards. And very often that hits people really hard. They're not aware of that. Limited companies usually, and I say usually again, because larger companies have a slightly different payment structure, but for all of the sorts of clients that we work with in the small and medium sized business arena, they pay tax once, corporation tax, 9 months after the year end. So it's a little bit simpler to deal with on the corporation tax side. And lastly, the thing that we probably spend the most time explaining in our business, and we have this conversation over and over again, and it's never a stupid question to ask. I know sometimes clients come to us and say, oh, I'm really embarrassed to be asking you this again, but when can I take money out of the business, and what's mine and what belongs to the business? And it's never a stupid question. It is a bit complicated to get your head around. The money in the bank of a sole trader belongs to you, and you can use your usual personal bank account if you want to, although we normally recommend at least splitting your business and personal banking into 2 separate personal bank accounts just to make things a bit easier. But you don't have to tell anyone when you take money from the business to spend yourself as a sole trader. In a limited company, the money in the bank is not yours to spend. And we say that over and over again. It is the limited company's money and it does not belong to you. So there's another step that's needed. You either have a salary through the payroll or a dividend needs to be paid out first. And that has to come out to you so that the money becomes yours for you to spend yourselves. Sometimes a director or a shareholder will lend money to the business through what's called a director's loan account, sometimes shortened to a DLA. And the business can then pay that back to you when it can afford to. And this often confuses new directors. It's a conversation we have with all of our clients when they're running companies, is what's going on in your director's loan account? Have you taken more money than the business owes to you? What are we going to do about that? And it often means that we just need to keep a really good eye on what's going on in your books, so that any stage of the year, not just at the year end, but during the year, we can look and say, right, the business can afford to pay you this much money, or alternatively, you've taken more money than the business can legally afford. We've got to declare a dividend, change your salary, or do something in order to make sure that you're not overdrawing that DLA. So that's a quick rundown of the differences between the sole trader and the limited company structures. So the next thing I want to talk about are the legal obligations of a director. A quick bit of background on the Companies Act. So when I first came into accounting, many years ago now, it used to be that a limited company had to have 2 people in charge of it. So at least a director and a company secretary. Very often you'd see 2 directors, and that was really normal. The Companies Act changed that, so it became possible in the UK to set up a company with just one director. And that's meant lots of flexibility, which is helpful. But what it does mean is that there's less of a pressure on people to have a board meeting, to note down the things that are going on in the business, to keep those minutes, which you actually do have a legal obligation to do. And it's meant that without a company secretary, and a company secretary's job was to ensure that all of the filings were done in time and to the right places for the company, to run the company properly. And without there being an obligation for there to be a company secretary, the obligation to keep those up sort of got a little bit lost. It hasn't gone away though, and as a director of a company, you have these legal obligations. They're put out on Companies House. So I'm just going to run through them very quickly so you're aware. If you do say, yes, I'm going to set up a company and become a director, this is what you're signing up to. So you have to act within your powers. It's a funny old bit of phrasing there, isn't it? What it means is that when a company is set up, it has some legal documents that tell the company how it should be run. And these are sometimes called the mems and arts, the memorandums and the articles of association. And they are a set of legal words that say what you must do within the company. And as a director, you have to make sure you act within the powers that are put out in those mems and arts. When a company is set up, very normally you use a standard set of these wordings. So all the directors have basically the same obligations, but it is possible to change them. And so you have to be very aware if you are acting as a director for a company and those articles of association have been changed, you need to know what they are. And you need to know how you're allowed to act, like what decisions are you allowed to make on your own, or what do you have to get other directors to be involved with? Are you allowed to declare dividends? Or do you need to check with the shareholders before you do that? Lots of things that can be changed in that sort of legal setup of your business, and you need to know what those are. So the second one is you must promote the success of your company. Seems sort of obvious, doesn't it? But you do have an obligation as a director to do everything you can to make your company successful. That means you can't pull against the values and the best benefits of the company. You must exercise independent judgment. That means you can't just sign things off without thinking about it. You have to actually stop and think about what's the right thing for the business and to use your judgment carefully. And if you are a professional, so for example, if you're an accountant like we are, you have a higher expectation of what your independent judgment would be, and you have to be able to show that you've done that. So gone are the days where you could just sign things off willy-nilly without checking them over. This might be something like a set of accounts. You must actually be engaging as a director and using your judgment. You've got to take reasonable care, skill and diligence. And that's, it seems sort of obvious, doesn't it? But if you're a director, you must be careful to run your business properly. You must be aware of what those obligations are. You must read the paperwork that you're signing off, and you must be diligent. And that means you can't just ignore your company for a year and then throw accounts in on the last day before the deadline. You have to actually make sure that you're doing the best for your company. You've got to avoid conflicts of interest, so you can't do things that benefit you personally against the interests of the business. And there are a couple of smaller things at the end which don't tend to affect our sort of size of companies, but not accepting third-party benefits. That's about you as a director taking things that the company doesn't know about, or perhaps being able to benefit from agreements that happen with your suppliers or your customers outside of what goes in the best interest of the business. And you have to let other people involved in the business know what interests you have outside of the business so that you can't be misleading them. So there are some obligations there that you have to be aware of if you become a director. So what should you be measuring to help you decide if you should become a director or not? So I've got this long list here. Don't worry about writing this down, because I hope Vicky's going to be able to share in the chat with you guys a link to a download we've got. It's an Excel sheet. It's got all of these areas. And what we suggest you do is use that sheet to measure where you are now in the business that you've got. And if you haven't even started your business yet, you can say, what do you think you're going to manage in the first year on all of these different areas? So we've got turnover in there. Turnover is how much you're going to make in sales in the year, sometimes also called revenue. You'll see these are interchangeable terms, but what do you think you're going to be bringing in over the first year? And then the way we've set up this worksheet for you is we've got this year, next year, and then what's going to happen in the next 3 years. And it's just to start to give you an idea of where your business is heading and when you might need to make that decision to change from a sole trader to a limited company. Or alternatively, it's if you're just on the verge now, you might want to see how it's going to affect you going on. So the reason we've got all of these different measures is that it's not a hard and fast rule making this decision. It's going to be interaction between all of these different areas. But we'll look at your turnover. We'll find out what your profit level is, number of people that you currently employ or you are planning to employ. And the reason that particular measurement is in there is because, in my opinion, as soon as you become an employer, it is safer for you to be doing that as a limited company. Being an employer has an enormous number of obligations involved in it, and there's liability that comes alongside that. Now, you can insure as an employer for certain for employers liability insurance. You should have that if you're employing people anyway, but there are things that can go wrong when you employ people, and they can be very costly things that can go wrong. And what we suggest then is, if you've got a limited liability company wrapping up that employment as the employer, it puts you as the owner at one position removed, and it makes it much safer for you to be in that situation. So we tend to say, if you're going to tick that there are going to be people employed in your business, you ought to really consider moving to a limited company. How many owners are you going to have? So if it's one owner, then a sole trader may be right. If you're going to have multiple owners, it's probably going to be more tax efficient to go into the limited company. So it's good to see how many owners you're going to have of this business. What type of customer are you going to have? Do they mind if you are a sole trader or you're a limited company? If you're going to be working with big corporates, for example, and they might have some kind of procurement system that you've got to go into, they may not even consider you if you don't have a limited company. So it's really important to know what sort of customer you're going to be dealing with, and that might change in the future, which is why we want to think about that going forward. Because if at the moment you're servicing perhaps business to consumer, where they probably don't mind quite so much if you're a limited company or a sole trader, but you're planning to move into a business to business type of business model, then you're going to want to think about what your entity says to those people and how you're going to be regarded. Are you VAT registered or not? So you need to be VAT registered as soon as your turnover goes over £85,000, which is why we ask you to measure that turnover as well. So it may be that you will have to become VAT registered. It's possible if you've got a smaller turnover than £85,000, you are VAT registered as a sole trader anyway, because it suits your business type. And there are lots of reasons why you may voluntarily choose to become VAT registered. It tells your customers something about the size of business that you're running. It may be that the things that you're buying in have VAT on them and you want to be able to claim that back. So lots of reasons why you might be VAT registered, even if your turnover isn't over the threshold. But if you're VAT registered, again, there's that risk involved in being VAT registered as a sole trader. If something goes wrong with your VAT, you're personally liable for it. Within the limited company, you're limited from that liability. So it's definitely worth considering that. And that's one of the things in our "Should I become a limited company" check sheet. We want to talk about your expected future growth. Where's this business going to go? If you're at early stages in a business and you've got big growth plans, you don't want to have to start in one entity and then change later on. That can be a bit complicated. You might want to start off as a limited company. Alternatively, if you're at the other end of your business, so you might have grown a business and now it's actually contracting down towards retirement, moving into a limited company in the last few years of your business might not be applicable. It might not be the right move for you. So thinking about what your expected business growth is really important here. Have you got plans to borrow? We ask that question. It's definitely something that's come to the forefront over the last few years because of bounce back loans, business recovery loans. The lending landscape has changed enormously over the last 48 months. So planning to borrow is something much more at the front of people's minds. And when you are making borrowing and you're borrowing for a business that's got some big plans, there is risk involved in that. We're much more aware of risk now than we've ever been before because of what happened during the pandemic, lockdowns, the way that COVID affected so many businesses. We just could never have foreseen that. So people had borrowing that they thought they were going to be able to deal with and then suddenly couldn't pay back. And when that happens in a limited company structure, there is a way of moving through perhaps liquidation or insolvency where it doesn't hit you personally and you don't end up having to pay back that debt forever. That's if there aren't personal guarantees on your borrowing. Sole traders, that borrowing all belongs to you personally. So whatever happens to your business, even if it shuts down, you're still liable to pay back all of that borrowing. And that could be really risky. And that could perhaps be putting your home at risk or other assets that you own. So we're very careful when we're talking about borrowing to make sure that directors don't put themselves at too much risk when they're making those borrowing decisions. And the last thing is the exit strategy. So you might want to sell your business. You might want to hand your business on to your children. There are lots of things you might want to do when you get to the end of your business. And you might have quite a long window on that, or you might be thinking about that in the next couple of years. A limited company, as we've already discussed, is in some ways easier to package up and sell on to people, and it may have more value because it's in that structure. So you want to make sure that your exit strategy is something you're measuring, and then you're able to make the right decision for your limited company. So what does the first year of running a limited company look like? I've got this slightly small a PowerPoint slide here, and what we will do is make sure you've got copies of these after we've finished the webinar, so you can just sit and spend a bit of time looking at them if that's what you so need. Now, I've not put dates onto here because, as we discussed right at the beginning, limited companies can have different year ends. Unlike your sole traders who are working to the 5th of April, limited company could be at any point of the year. But this is what the setup and the start of a limited company year would be like. So what happens first up is that you have to incorporate. That's setting up a limited company with Companies House. There are a few ways that you can do that. Many accountants will set up limited companies for you. It's a service that we offer lots of our clients. And it doesn't take very long. Probably within 48 hours, you can normally have your company number and your lovely certificate to say this is the limited company. That incorporation takes a little bit of admin, so you need to have decided what your name is, and you can't have the same name as another limited company. You also probably want to check, these days we're just as interested in domain names, making sure somebody else doesn't have the domain name of the company that you want, and ensuring that your name isn't too close to another business, especially one that has either been wound up or is going through a liquidation process, because you don't want to be looking too like a company that's in trouble, because sometimes people will look up your business and get confused between the two. So we're always careful to make sure that our name is separate from any other potential business that it could get confused with. And there are also a few words that you're not allowed to use. So for example, you can't use words like king or royal in your name without special dispensation. So you just have to make sure that you're not breaking any rules like that. And so once you've incorporated your business and you've told Companies House who the shareholders are, who the directors are going to be, where the registered office is going to be, and that's the place where official paperwork is going to get sent to, where people can turn up to look at the records of the business. So you need to think quite carefully about where you want that to be. Once that incorporation is done, your next step is to open a bank account. So as we talked about a little bit earlier in the webinar, the money of the limited company does not belong to you, and therefore it cannot sit in a personal bank account. We sometimes find clients come to us with that going on, and it's not okay. You must have a business bank account for a limited company. And these days, actually, it doesn't take too long to get these set up. We found especially during the pandemic, it was quite difficult to set up companies with the traditional high street banks, but the more forward-thinking banks, the online banks and the so-called challenger banks have got really good at this, and they've got some really nice processes to help you through that. So setting up your bank account shouldn't be too tricky. You might want to try people like Starling, Metro Bank, who do have a high street presence if you want a branch you can walk into, but are also very much an online bank. Once you've got your bank account set up, you can then start doing the next bits. It's really important you get these done in the right order. You can't open the business bank account until you've got a business name and number incorporated, and you can't do lots of other things until you've got your bank account open. So you need to make sure you do those in the right order. Once you've opened your bank account, you can start trading, you can start receiving money into that bank account, and you want to be starting off using the accounting package that you're going to use for the future at that point. It's a lot trickier to go back and make the records at the end of the year. You really want to be keeping your records right from the beginning. And that's something that we help lots of clients do. We use Xero, but there are other packages available. But we'd definitely be suggesting, if you're starting a limited company right now, that you're using a digital record keeping system right from the start, because there's going to be an obligation coming your way under Making Tax Digital, whereby HMRC will expect you to be using a package. Spreadsheets and handwritten ledgers aren't really going to cut the mustard for many more years, so we'd suggest going straight into your package from the beginning. You're going to want to, at some point, perhaps register for VAT, for PAYE and for a pension scheme. So let me just take those three separately, because when you do that will differ from business to business. But registering for VAT, you must do that over £85,000 of turnover. You may wish to do that right from the start of trading, or it may be sometime during your first year, and that's going to depend on who you're servicing, what sort of customers you've got, and the sort of costs that you've got involved. But you can't register for VAT, or it's difficult to register for VAT until you've got a bank account open. So that's why we suggest you do it once you started trading. You're going to want to register for a PAYE scheme pretty much straight away, assuming you're going to receive a salary as a director. And we would normally advise that you do take money out of the business that way. And we're going to talk about that in a couple of slides' time. And it's very likely you're also going to need to register a pension scheme. That's a really good way of saving for your future, for the business to be able to put money away for you in a very tax efficient way. And if you're going to have employees who aren't directors, you must have an auto enrolment scheme set up. So making so that's an auto enrolment pension scheme. So making that decision quite early on means that you can get all of that registration done during the first year. We'd also suggest that you set a budget for the year. Now, normally you'll have done a business plan before you've incorporated your business, or at least in the very early stages of your business. So we'd suggest you've got that business plan already there. And from your business plan, you should be able to set a budget for your first year to say, how much are we expecting to spend on all of these different things? And how much do we think we're going to make in revenue? That is a very difficult thing to work out with a brand new business. But just because it's difficult doesn't mean you shouldn't do it. Just don't get hung up on it being right. It's a different mindset, setting budgets, from keeping a set of accounts. Accounts must be right. They've got to tell the truth of what's going on in the business. Setting your budget is, what do we think practically we can achieve? And just get that into your accounting package. So if you're using Xero, we'd really recommend you putting your budget into Xero as well, because it allows you to then report against it on a monthly basis. And that's really helpful to see if you're on track. And then the next thing we suggest you get sorted out in your first year is at least quarterly reporting. Ideally, you'll do monthly reporting and see how you're doing against your budget each month, but at least quarterly reporting to make sure that you're aware of where your business is going, if you've crossed any thresholds, so that might be crossing the VAT threshold, or needing to take on a new employee. If you're not looking at your numbers at least quarterly, you're just not running your business in line with those directors' duties to ensure that you're taking due care and attention, and that you're actually being hands-on with running your business. Quarterly reporting is something that's really easy to do. If you've got your data going into something like Xero, you can just pull your reports from there, or you can talk to your accountant about having sort of accountability meetings and making sure that you're keeping on track with doing that. We know what it's like in the first year of trading. You're so busy in the delivering of the thing that you do that it's really difficult to keep an eye on the administration of your business, actually running the business part. And that's why having an accountability buddy or a partner or a mentor or a group can be really, really helpful, because it means you take time out to step back and say, right, am I on track with my business? So that's what the beginning of the first year looks like. And we've sort of got ourselves up to the things that should be going on within your business. The last three that I put at the bottom happen just after the first year, but they are obligations that you've got. So you must file a confirmation statement with Companies House. That has to be done on the anniversary of the incorporation of your business, and at least once a year. You can file confirmation statements more often, but at least once a year you must file this statement. And what it says is, who's the director, where's the registered office, who are the shareholders, who are the people of significant control. And this is a technical term. It's a matter of fact rather than what's written on a piece of paper. So who is it that actually controls this business? And sometimes we find that the person of significant control isn't particularly the director. It's maybe the spouse of the director who says, actually, you should be doing this. Let's go and sign this agreement. And they might not have any official role in the business, but they're actually directing the business in reality. And we need to know who those are. It's really important. So they are people of significant control, and you must keep a register of those as a limited company and then report on it in your confirmation statement. Very often we find new directors get a bit confused because that gets filed at Companies House, and sets of accounts also get filed at Companies House. Sometimes people get confused between what's the confirmation statement and what are the accounts. These are two totally separate filings. The confirmation statement has a fee attached to it, so you have to pay £13 to Companies House at the same time as filing your confirmation statement. And you've got to do it within 14 days of the deadline. So it's a really short deadline. If you go on holiday over your confirmation statement period, you could miss it. And that's why very often clients ask their accountants to file these on their behalf, because it's just another bit of admin to remember. And we're very used to doing it. So that's your confirmation statement. You have to prepare annual accounts. Normally, you prepare them to the end of the month after you incorporated. So your first period of incorporation, first period after you've incorporated, is very often 12 months and some days. That can be a bit complicated in your first year of trading, because it means you've got to do a long period of accounts, they're called. It means you have to put in 2 corporation tax returns. Again, your accountant should have this absolutely covered. It's not something you should be worrying about. They will talk you through what it is that you need to do, but you need to be aware that after your first year is over, you've got 9 months to get your annual accounts prepared. You as a director have to read those and make sure that you're happy that it gives a true and fair view of what's happened in your business. So just because you've asked an accountant to write them for you doesn't mean that your job is finished at that point. You must read them and sign them off, and you should do that alongside your accountant, and you should ask hundreds of questions. It's fine to ask questions at that point, because you are going to sign these off to say yes, they're right. You must understand what that profit and loss account says, what your balance sheet is telling you, and you need to be prepared to answer any questions about that if you were asked them, because as a director you should be taking a diligent approach to that. And then the last thing is you must file and pay your corporation tax. So you need to make sure that those get filed within, your accounts get filed to Companies House within 9 months. Weirdly, your corporation tax return is due 12 months after your year end, but you must pay your corporation tax within 9 months. So it's very topsy-turvy, because in theory, you can pay your corporation tax before you've filled in your corporation tax return, but how would you know how much to pay? It's daft. So we always suggest to clients, just stick with the 9 months rule in your head, and you don't need to worry about anything else. Paying your corporation tax is just once a year rather than on account like you do as a sole trader, and it's worked out at 19% of your profits. So that's a quick run through what the first year of running a limited company ought to be like and the things that you should be aware of coming up. Now, I'm going to just switch over to Vicky, who's going to talk you through what costs can you claim. This is something we get asked an awful lot, and she's going to talk you through this next section. So over to you, Vicky.
Thanks, Tori. Okie dokie. So generally speaking, any expenses that you incur wholly and exclusively to operate your business can be claimed. This is no different really to sole traders. So, but if any purchases are partly used for business and partly personal use, these can be apportioned using a reasonable calculation. So if we start off with the director's salary, which is an allowable business expense and is an important element to consider, as this gives you a year's credit towards state benefits, such as the state pension through the national insurance contributions. Other factors regarding your personal and business situation need to be taken into consideration to set the level of that salary. So this should be discussed with your advisor. Pension, in the same way, your company can make pension contributions on your behalf, and this is in fact one of the few remaining tax breaks available to limited companies. Putting money away for the future is not only a tax efficient way for a director to distribute profits from the business, but reduces corporation tax due as well. There are again limits around the amount the company can pay into the pension scheme for directors. So again, further advice should be sought before going ahead, so that it can be tailored to your personal and business circumstances. Use of home for office. There are standard amounts that can be claimed without providing proof of costs, and more complicated calculations are available. Again, your advisor will be able to discuss with you the most appropriate option for your circumstance. Travel. Any travel that is necessary in the course of your business is allowable, except travel to and from home to office. These costs include mileage or public transport. However, it should be noted that HMRC disallows air travel abroad that includes any personal time, such as adding a weekend to the beginning or end for sightseeing. Yep, we know this seems harsh, but remember, we don't make the rules. Computers, printers, office equipment, or any assets with a useful life of more than 12 months and are above an agreed value, say £250, £500, depending on how you feel about the items you're buying, are classed as a capital expense, and there are different tax allowances available for those called capital allowances. This again is no different to sole traders. However, for limited companies at the moment, there is a super deduction available until 31st of March 2023, which is there to encourage investment and allows you to claim 130% of the cost of equipment as a deduction from your profits before tax. Cars. These are allowable, but careful consideration must be made before adding these to your business, as there can be a high benefit in kind charge, which affects both employers' national insurance and personal tax. Although for the time being, electric cars are an attractive option. For all other car types, it can be more beneficial to claim business mileage instead. Once again, talk to your advisor before making the decision. Vans, on the other hand, are fully allowable without a benefit in kind charge if used solely for business, and also come under the capital allowances super deduction. Consulting and professional fees, accountancy or other professional consultations are fully allowable costs, as is staff training. Entertaining. Whilst these costs are allowable from a business accounting point of view, they are not tax deductible and are therefore added back to the profit before tax is calculated. Obviously, this is not a comprehensive list, but these are common areas that we get asked about most frequently.
Brilliant. Thanks so much for running through those, Vicky. I think Vicky very often is at the sharp end of these kinds of questions, and I know from experience that we probably get asked one or two of these at least once a week by clients. So it's definitely something that you shouldn't ever feel embarrassed about asking about, because we know it's complicated, as you've heard, and it is specific to everyone's different places that they are within their business. So it's always worth just double checking that you're doing the right thing in your business before you go ahead and commit to, for example, buying a new 4x4 through the business, and then your accountant throws up their hands horrified to say, oh my gosh, you create an enormous tax position for yourself. So always take advice. The question I probably get asked the most out of anything else, and that's across the board in everything that I do as an accountant, is how do I take money out of my company, or how much can I afford to pay myself? It's a really common question. So we generally recommend a couple of ways, and of course it's going to depend on your specific situations. If there are other directors and shareholders that are involved in your business, how much profit you're making, these kind of things will definitely change what we would advise. But you should have a remuneration strategy meeting with your accountant or an advisor or a mentor, to make sure you've got this right for your business, so that you know what the overall strategy is for taking money out of your business, rather than just doing it on an ad hoc basis, which is the most common way of doing it. Is, I need some money, I need to take it out of the business right now. How on earth am I going to do that? Much better to have a strategy that says, when our profits go above X, we're going to do Y. Up until then, we're going to take this much out. And if you can make that as part of your business planning session, then you're going to know where you stand. So, okay, let's talk through what you can do. These are some sort of tried and tested rules of thumb that we would tend to use as a starting point. So, salary. As a director, you're technically an employee of your limited company, and employees pay national insurance on their salaries, as do employers. So there's employees' national insurance and there are employers' national insurance contributions. So an ideal tax position is to pay a salary that's high enough to count as a year of contributions towards your state pension, and that's based on national insurance thresholds, but low enough not to incur too much national insurance payment. So what happens with national insurance is that as soon as you're deemed to have made national insurance contributions, and that deemed is kind of important because you don't necessarily have to have actually paid any national insurance contributions, you just had to have had earnings in the right thresholds. As soon as you're deemed to have made a payment, then that counts towards 1 year of the state pension. And you need to make a certain number of years of contributions in order to get your full state pension at the end of the year, at the end of your working life. So when we're thinking about how much to pay ourselves, we often want to just step back and say, what am I going to retire on? Am I going to have enough contributions to make my state pension? And we want to build that into what our strategy is going to be. For a sole director, the amount is slightly different to a director with other people on the payroll, be that other employees or other directors. And this is because there's something called an employment allowance, and that at the moment, well, it's going to go up on Wednesday, so just about. So for the next year, 2022-23, the employment allowance means that the first £5,000 of employers' national insurance contributions don't have to be paid over to HMRC as a small employer. That allowance is not available if you're the only director on a payroll. So you want to just bring that into your thinking. If there are two of you involved in your business, and you probably should both be directors, but you've only got one, you might want to bring the other director in. You might want to consider it when you're bringing on employees. But if you've got more than one director on the payroll, then you can use the employment allowance. And so if you're a sole director, the usual optimal salary for 2022-23, so that's the tax year that's just about to begin, will be £9,100 a year. And if you're a company with 2 or more directors, it's going to be £11,908. I know that's really specific. It's unusually complicated this year because we've got a change to national insurance thresholds that were announced during the budget, and they're going to change on the 5th of July, not at the beginning of the new tax year, but 3 months into it. I think it's just to keep us accountants on our toes. And that's why we've got a slightly odd optimal salary rate for this year. Thanks, Rishi. But we can definitely talk people through that. So it's either 9,100 or it's 11,900-ish. And that's where we would suggest you set your salary, given all other things being equal. So then we come on to dividends. Dividends can only be paid out of retained profits in a business. Let me say that one more time, only out of retained profits in the business. It's really, really important that you understand that. We often see people declaring dividends through the year, even though they're not keeping a track of their profitable position. You get to the end of the year and you find out you've over-declared dividends. That's not legal. You can't be declaring dividends if there is not enough profit, either this year or from previous years it's been retained, to pay them out. So it's very, very important that when you're running a limited company, you know what your profit position is at all times. Ideally at the end of each month, even at the end of each quarter would do, because you can't be declaring dividends out of profit that doesn't exist. It means if you're making a loss, you need to think about other ways of taking money out of the business. It's possible to pay a salary if you're in a loss-making position, assuming the company isn't going to be running into an insolvency issue. So if you are in that position, it's really important you take some good advice to make sure that you're not taking more money out of the business than you can afford to, because it's that sort of thing that can make a suggestion that the directors were not living into their legal responsibilities to work in the best interests of the business. So if you're getting into that kind of position, it's really important to pick up the phone and talk to somebody about it. Dividends, you can see here, we've got these quirky rates, 8.75% from the 6th of April 2022. So that's your personal tax that you pay on dividends that the business has paid out to you. Dividends come out of already taxed profit. So the company pays corporation tax, it then distributes its dividends to its shareholders, and the shareholders then pay nothing on the first £2,000 of dividends, 8.75% on dividends up until the higher threshold, and then 33.75% if you're into the higher rate. And there is actually another rate if you're taking dividends over £150,000. We're not going to go into that today because it's a bit of an edge case, but there is a slightly higher rate after that. How do I know how much I can legally take? Well, you have to be tracking your accounts correctly. So you must keep your bookkeeping up to date. You must make sure you're doing your bank reconciliations, or you've got a bookkeeper doing that for you. And then you can refer to those to make sure that you aren't illegally declaring dividends. And it's also worth being aware that you can make pension contributions, as Vicky already discussed, as a different way of taking money out of the company for your benefit. And it's really tax efficient to do that. So that's something that you should be considering if you're getting up into those higher rates. If you're looking at paying 33.75% tax on your dividends, it might be better for you to say, actually, I'd rather make an employer's contribution into the pension, tax deductible. It's going to put money aside for my future. At 55, I can take some of that out tax free. And so that can be a really tax efficient way of getting money out of your company. And that last point I've got there is to check your pension years. Because of this national insurance contributions needing a certain number of years to get your full state pension, there is a way on the HMRC website, you can log in using your government gateway login and look at your personal tax dashboard. And on there, you can get a forecast of your state pension, and it will tell you how many years of national insurance contributions you have already made, and therefore how many more you need to make in order to hit the target for getting a full state pension. If there's one takeaway from today, scribble this one down, go and do that. It takes only a few minutes and it'll give you a lot more clarity about how many years of salary, if you're into a limited company, how many years you're going to need to put a salary through in order to get your state pension. It will also highlight any gaps in your record. And you may think that you've always been employed up until this point, or you've always been self-employed and you've made your national insurance contributions, so there's no way there's a gap in your record. I thought that too when I was employed. I went and checked my record and it turned out that HMRC hadn't been putting my national insurance contributions to my record. I'd had a temporary record set up, and if I hadn't checked it, I would have been ineligible for any state pension when I get to that point. So go and check your pension records. It's really, really important, and it'll inform you the best way to take money out of your company. Right, we are into the tips and tricks area. So we've put together this slide because there are things that we know as accountants, and we often just talk about internally, and we don't always share it out to clients in a simple statement. It often comes out of discussion with them. We say, oh, of course you can change your ARD. I'll tell you what that is in a second. But we don't tell you that up front. And it's good to know what these things are so that you can build that into your strategy. It's all about building your knowledge as a director so you can make good decisions. So the first one I've got is that you can change your ARD, your accounting reference date. Now, this is the date that Companies House holds for when you're going to file your accounts to. We often change these for clients because they're either at an inconvenient time of the year. So, for example, if you, let's say you sell barbecues and you've got your accounting reference date as the 31st of July, you're really busy trying to do sales, trying to get things out of the door to all of your customers that are buying. You've got lots of stock coming in and out. So trying to put together your stock take, work out who owes you money, pay all of your suppliers off before the end of the year, it's a right headache. Well, you don't have to have that position. You could just say, let's move it to October. It's a nice quiet time of the year. It would suit us much better. So you can change it for that reason. You can also create long or short periods of accounting. There are times when that can be very beneficial. If you're having a period with quite a lot of loss making and you want to use that loss and carry it back, you can file a set of accounts for a short period so you can carry back your losses. Alternatively, you might want to have a long period in order to encompass something that's going on in your business. And you can do that too. There are lots of provisos around when you can make those changes, and an accountant will help you make that decision. But it is something, it's something that's in your pocket as a limited company that you don't have as a sole trader, and it can really help you deal with tricky tax positions. So make sure that if you're like up against a wall and you're not quite sure what to do next, ask your accountant about changing your accounting reference date. It might just save your bacon. You can split shareholdings to make the most of dividend tax-free bands. What we mean by that is if you run your business and your spouse doesn't have dividends, doesn't have other shareholdings, and you want them to be involved in your business, you can give them some shares in your business, and magically you've suddenly got two £2,000 bands that you can use between the two of you. And you've also got, if they're not using up all of their lower rate band, you can suddenly use up their lower rate band by, for example, giving them a salary or giving them dividends, and it'll avoid you going up into those higher rate tax bands. There's some really quite quick and easy things that you can do about splitting up shareholdings, perhaps for a family business. So you might also have grown-up children, for example, that you would like to give some shares to. You could give them £2,000 a year of tax-free dividends, and you can use Class A and Class B shares to do this in a clever way, which means that you can get money out of your business in some really tax-efficient ways that are completely legal. You can declare dividends over 2 tax years. As a sole trader, you don't get to do this. Your profit is taxed. There's no ifs and buts about it. You make a certain amount of profit and it will all get taxed in that year. Dividends, you choose when to declare them. So you can have an interim dividend. That's a dividend that's declared during the company's year, and you can have a final dividend, and that's declared at the end of the year. So for example, if your year end was the 31st of July, you could declare an interim dividend at the 31st of March, which would fall into one tax year, and you could have a final dividend at the 31st of July that falls into the next tax year. And by doing that, you can use up 2 dividend tax-free rates and 2 personal tax years worth of allowances, and really cut down your tax bill. So thinking about the date you declare your dividends is really important, and accountants can again help you make that decision in the right place. Company pension contributions. I did see popped up, I think from Emma in the Q&A, a question about can company pension contributions be used against tax, and if you are a sole trader and you're moving into a limited company, can your company make contributions into your pension fund? The answer to that is yes, usually, and it just depends on what sort of pension fund you've got at the moment. Assuming it's a SIP, a self-invested pension plan, which very many clients do come to us with, yes, you can normally get an employer's contribution made into your SIP on your behalf, and that employer's contribution is tax deductible for corporation tax reasons, and you get the benefit of it going into your pension and building for your future. So that can be a really tax efficient thing that you can do. And if you've not used up all of your pension contribution thresholds for previous years, you can use old thresholds up as well. So there's definitely some tax planning to do around that. And lastly, as Vicky mentioned a little bit earlier, this super deduction for capital allowances is 130%, is very, very useful. So if you're growing a business and you're going to need equipment in order to do that, and that could be office equipment or it could be plant and machinery. You know, if you've got a business that, for example, was a carpentry business and you needed to set up a workshop, and you're thinking about doing that in the next 18 months, you really want to do that before the 31st of March 2023, because if you spent £10,000 on equipment, you're allowed to knock £13,000 of cost off your profit and loss account for working out how much corporation tax to pay. That's really beneficial. And we assume it's going to go away after 2023. It was brought in as a COVID sweetener to help small companies, and you want to make the most of that. It's a very useful deduction, so that's going to help you with your corporation tax bills. So those are the things that are sort of tips and tricks we keep up our sleeve as accountants, and here we are giving it all away to you guys for free. So let's talk about next steps. My aim today is to help you take what you've learned and implement some positive changes for your business. We always say doing nothing is not an option. You do need to ensure you're making a decision based on information about your current business. Even if that decision is to continue as a sole trader for now, make sure that it's a decision you're making rather than something that's just fallen onto you. And so I'd really advise you to go and grab that worksheet from the chat, and we'll make sure the link to it is sent out in our follow-up email as well. And go and make sure you're making the right decision for your business, not just staying where you are because it's too scary to move. Remember to put your oxygen mask on yourself first. We always say this. Planning a future strategy for your business starts with you and perhaps some other leaders in your business, and you have to take time out in order to make these decisions. It's not something that is just going to happen for you. You've really got to be able to step out of the business. So one of the next steps for you should be to book an hour into your diary over the next couple of weeks to just have a really good look at this and make sure you're making the right decision for your business. Make a clear plan. It needs to be something that you can articulate to the other people in your business if there's anybody on your team, or that you can just refer back to. Very often we find at the end of a webinar like this, you're full of great intentions. You're like, right, I'm going to make a decision and I'm going to do this and this and this in my business. And then stuff happens, doesn't it? You get delivery that comes in, you get really busy just doing the doing. And 6 months down the line, you say, oh, what was it I needed to think about with becoming a limited company? I can't remember. If you keep that worksheet running in front of you, you can see all of the information that you've already got, and you can help yourself to make the right plan to get on with making this growth decision for yourselves. Focus on what you can do as opposed to worrying about what is out of your control. We know what's going on just now in the business world. We've had so much change and uncertainty over the last 2 years. It's really exhausting, but there are certain things that you do have absolute control over, and that's what the business setup looks like for you. So really focus on that. And lastly, know that we are here to help. Vicky and I love talking to potential clients, non-clients, people who have got an accountant that they're happy with, but just want to have a different conversation that maybe they're not getting at the moment. All of those situations, not a problem at all. We'd really like to hear from you, and we're very happy to give you the benefit of our expertise in this area. So how can we help you? Well, we know there is so much involved in starting a limited company or running one if you're new to it. So we've gone ahead and developed a 6-month program in response to the many, many questions and worries we've heard over the last 15 years, supporting people just like you in making this transition into running successful limited companies. What we have put together is an in-person monthly group where there's an in-person meeting, probably 3 to 4 hours. We're going to cover all of the topics that we know you need to know about. dig deeper into some training for you and do some really practical hands-on advice, going through Xero with people, answering the questions that you've got, so that you can supercharge the move into your limited company. And our aim for this group is that when you come out of the other end, you feel totally empowered that you're running a company as best you could, and that you're getting all of that wonderful information really quickly and upfront, so you don't spend years getting yourself into a position that you feel like you know what you're doing. That group is going to be a paid for group. It's going to be £150 a month for those 6 months, and it's going to create a real community around it. So it's something we'd love to talk to you a little bit more about. We're very happy to jump on a call and talk through what's going to be involved and what sort of commitment there is time-wise from you guys. We also run business planning sessions. We do this for clients and for non-clients alike. It's a standalone session. It normally, in the ideal world, we do it face-to-face in a room, lots of flip charts and stickers. It's really interactive. Normally takes between half to 3/4 of a day, and it has a couple of people from my team. And the aim is that you walk away with a fully written business plan that you can implement and check in against year by year. We charge a flat fee for that. It's £1,250 plus VAT. And we've always got really great feedback that comes back from the people that attend that business planning session. And we run that every single year for clients and non-clients alike. You can also download the worksheet that I've already spoken about. You can track your information in that. That's absolutely free to you. And we'll also do complimentary meetings. Again, absolutely free, half an hour on the phone or over Zoom, where you can talk through particular questions that you've got. We're always happy to do that with anybody that we've spoken to. I just have to add in right at the end, the information in the educational webinar is general in nature, and it's no substitute for specific tailored advice and support. But there are lots of other ways that we can give you that tailored advice through groups down to one-to-one conversations. Okay, I'm aware of the time. How are we doing? 1:15. So I'm just going to nip over to Vicky. Hopefully you can hear me okay, Vicky.
Yep.
We've had a few questions that came in advance. Have we got anything else in the chat or in the Q&A that we want to talk through?
There's nothing further in the open question and answer or chat at the moment. So
Brilliant.
yeah,
Okay.
just the questions we've got before.
Okay, fine. So I've got a few things that people have asked me. So there are some people who weren't able to make today, but really wanted to have this webinar, and they have asked us a few questions that we're going to fill in anyway. So one of them is, if I'm already registered as a sole trader for VAT, what happens to my number and what do I do next? Vicky, do you want to answer this one, or do you want me to? I don't mind either way.
Yeah, no, I'm happy to answer this one. Yeah, so really it's some forms you need to fill in. There's forms from HMRC to transfer your business as a going concern. So it transfers from the sole trader or partnership to the limited company. It's a bit strange if you're the same person, because you're signing over permission to transfer it and then you're agreeing to take it on the other side of the form. But that's basically it. And then the number and VAT quarters continue as you go along. Obviously, anything that's owed from the sole trader side of the quarter or VAT registration is then payable by the limited company.
Super, thanks for that, Vicky. It's definitely something that sometimes catches people out and they forget to do the transfer. So they set up the limited company and they do the other part, and then a few months down the line they go, oh, the VAT registration is in the wrong entity's name. It's really important that it gets moved across. So it's something that just needs managing. Brilliant. Where should I have my registered office? This is a big question. I'll pick this one up, Vicky. So the answer, as always with us accountants, is it depends. I know we say that an awful lot, but it really depends on your personal circumstances. We often find clients come to us and they don't want the registered office at their home address. Perhaps they're a female business owner and they feel a little bit vulnerable at having the registered office out in the public domain. Very understandable. It's sometimes because they're moving around an awful lot. So they're either in rented accommodation for home and they don't want that to be on the public record and then having to change it regularly. Or alternatively, they just want to look like they're looked after by an accountant. And in all of those cases, we offer a registered office service where we'll host the registered office at our offices, and it means all of the brown paper envelopes come to us, all of the junk mail also comes to us, and then we have an admin service where we'll deal with all of that, forward on the things that are required to be dealt with, and deal with anything that we can do. And a lot of people find that just taking the stress out of having the registered office at home is worthwhile. Other clients really like having the registered office at their own premises or at their own home, because then they get the post directly to them. And it sort of depends on what type of person you are, how good you are at dealing with paperwork, and if you want that out in the public domain. So there are lots of different reasons to use different registered offices. You also don't have to use either your accountant or your home address. There are serviced offices that will do this service for you as well. And then the last thing is what's involved in the Empowering Directors group. So that group that we've set up, we foresee it being a really hands-on group. It would be probably those 3 hours normally in the morning, we think. So you do 3 hours in the morning and then have lunch all together. So there's a networking side to it, so that you get to build up a group of like-minded business owners who are going through exactly the same growing pains that you might be going through. So you get to build up that community. And also it's going to be an educational group. So all about, how do I learn how to run my business as a director of a limited company in the correct way? How do I make sure I'm making the right sort of decisions? How do I know what I don't know? And I think for many directors, that's the biggest worry, is that there's a whole load of stuff I just don't know I should know about, and it suddenly hits me at the last minute, and I have to suddenly scramble to get to the bottom of something. It might be something like, we often find people are a bit unaware of what's involved when they first become an employer, and when do you need to pay your tax, and how does national insurance work, and how do I make sure I'm making pension contributions? And it's a place for all of those questions to get asked, where no question is a silly question. And we really believe that it's would always rather people ask whatever thing they think is silly, because somebody else in the room is thinking exactly the same thing, but are too worried to put their hand up and say, just, can we go back a second, and can you explain what a national insurance contribution is again? Or do I need to have a certificate for my dividends when I declare a dividend? What do I do at that point? What's involved in that? And we're going to go through that step by step, so that by the end, you are the best directors you could possibly be. So that's what's going to be involved in that group. If you're interested in it, please drop Vicky and I a note. We're going to be running that together, so you get some time with the two of us, and we'll bring loads of expertise into that group. Vicky, I think I've covered all of the questions that I've got.
Yes.
Yeah.
Yep.
Fantastic. Okay, that's brilliant. Well, then it just leaves me to say a big thank you to everybody for taking the time out to spend with us today. I know I've rattled through a lot of information. Vicky's shared a lot of information with you as well. Do take the time to go back and listen to this again. And I just want to have a parting thought. So the parting thought I've got today is from James Penny, who's the founder of JC Penny. Growth is never by mere chance. It is the result of forces working together. I think that's a really important thing to notice, is that a lot of us talk about wanting to grow our business, but it doesn't just happen. We actually have to make steps to get there. And moving from sole trader to a limited company is all about growth. And it's all about working together with those people who can support you to make sure that those steps are made in a fun and comfortable way. It doesn't have to be scary at all. There are lots of us out in the business community who understand the process really well and just want to support you through it. So you're not on your own, and we're here to help you. I would also say, make a simple plan as soon as we finish this webinar. I always find if I do anything else when I finished a webinar, I forget to follow up. So that plan should be, commit to at least 3 actions that you're going to take as a result of what you've heard today. Write those down right now and give them an owner if it's not going to be you, somebody else in your business is going to do this, and a date you're going to complete them by. If you feel really brave, ping them over to Vicky and I, and we'll hold you accountable to them as well. It can be really helpful to have somebody just to say, did you do that thing you said we were going to do? And remember, if you need our support, we are absolutely here for you. So thank you so much. We've really appreciated your questions. It's been great being able to share this with you, and to let us know if there's anything else that we didn't cover today that you're expecting and that we can help you with offline, or we can share together. We hope we've given you plenty of ideas to ponder and some clear next steps for you and your business. And I'll just take this moment to say thank you from both Vicky and I, and we hope to catch you on another webinar or in our Empowering Directors group really soon. Thanks and bye.
Thank you. Bye-bye.